Fed Chairman Ben Bernanke recently came out and told a Senate committee that he's worried about another bubble. This time, the bubble said to be in commercial real estate. Is that about to burst? Well, Peter Avalon is with me this morning from Ardsley Advisors, where he's a managing partner. And you say, Peter, among other things, that the government is not doing enough to correct this, or can they do anything to correct this bubble that may or may not burst in commercial real estate?
Well, not really, because the problem is very, very pronounced. You know, the situation we have right now is akin to a perfect storm as far as commercial real estate owners are concerned. Not only are they dealing with the effects of this very, very deep recession,
right,
but additionally, lending as we knew it as recently as two years ago has ceased to exist.
All right, let's talk about, you say very pronounced. Numbers that we've put to that, $3.5 trillion worth of commercial real estate, expecting almost 5% of that to go into default. That's your prediction, and that's a lot.
That's not my prediction. I mean, basically, that's the prediction of some economists that have looked at the numbers and gone through a very, very in-depth analysis. But remember that that amount is only the amount owned by commercial banks and represents only 50% of the market. The additional 50% of the market were loans originated by investment banks, commercial mortgage-backed securities, and basically the other quarter were loans originated by insurance companies, hedge funds, and the like.
Okay, so the question becomes one of timing, among other things, but there's these resets that we're expecting over the next few years that people are worried about. What is the timing in terms of concern and how, you know, macroeconomically this might affect people living their day-to-day lives that say, all right, the economy's bottomed out, it's turning. Is this, as other people have said it is, really the next shoe that will drop, and what will that look like?
Well, there are billions and billions of dollars of commercial mortgage-backed securities that have to reset over the course of the next few years. Commercial mortgage-backed securities tend to have a maturity of 3, 5, 7, or 10 years. I saw one estimate which assumed that 20% of all the hotel loans, which have to reset this year, apparently approximately $8 billion worth, may actually go into default.
And the hotels it's a rough business, obviously, with travel being down, but it's not like they're going to be able to make up for this. In other words, this is pretty much their fate. Is there anything that could stop that from happening?
No, not really. I mean, you know, one of the more famous hotels in our lifetime, the Watergate in Washington, D.C., defaulted on their mortgage.
So if it could happen there,
it could happen there, it could happen anywhere.
It could happen anywhere. Now, somebody watching might say, well, why doesn't the government step in, just buy some of this debt, and clean up the mess altogether? Why can't that happen?
The government has decided to buy some of the debt, but the debt they've decided to buy are the newer issued commercial mortgage-backed securities. Those are the deals that don't have problems. The deals that have problems are the deals that were originated based on an economic model which no longer exists.
And so that's, in other words, you had a loan, took it out 3 years ago, and you're making certain assumptions, and those assumptions are just completely out the window right now.
Yeah, for example, you know, a new owner of an office building in Manhattan, you know, assumed that rents were going to continue to go up. Rents are now going down. He bought the building 3 years ago, paid top dollar. That loan and that property is down probably 30% in value. Not only is the equity wiped out, but also the debt.
You know, it's interesting. I just want to go back to make one point on the hospitality industry, because this kind of resonates, I think, with a lot of people that are traveling or thinking about it. And this also speaks to government involvement or lack thereof to some extent. One thing that could have been done maybe differently is the kind of rhetoric that's been put out. I know you've made the point that, hey, listen, the administration coming out against the AIG situation where there were, you know, people traveling, taking these crazy vacations that got so much news, or the business meetings that got so much attention, that actually had the reverse effect.
Oh, disastrous.
Put us into this situation to some extent.
Disastrous. I mean, there are some luxury properties that are experiencing significant revenue declines every month for the past year, and those were the prime locations for corporate meetings.
It is. Sometimes we don't think of the, you know, the effects of these types of things when
it was ill-advised.
Thank you, Peter. Appreciate you coming in.
Thank you.
All right, so that's something to look out for as.